A lot of good stocks have rebounded from their day's low. It appears that people are wanting to buy the dip, something we've been speaking about on the channel. But let's talk about all the factors right now which are playing on the minds of the market with someone you've seen on the channel before. Is a friendly face on our channel, Ashish Somaiyaa. But today he's joining us from a new role, earlier with Motilal Oswal AMC and now CEO of White Oak Capital. Ashish, thanks very much for joining us. Congratulations on your starting off your new innings. Prashant Khemka is also friendly with us and he's a regular contributor on the channel, and now you joined him. Tell us, what's the plan here at White Oak?
So, Ajay, thanks for having me. It's very kind of you to invite me. As you mentioned, White Oak has been in existence for now over 3 years. And Prashant was the erstwhile CIO for Goldman Sachs for India equity and their global emerging markets. And he and the team founded White Oak in the middle of 2017. And as a larger group, actually, what you would say more like White Oak Group, through its international operations, manages nearly $2 billion for foreigners investing into India. And this is managed through Singapore, Dublin, London, and Mauritius. And as far as India is concerned, of course, there is a set of local operations, which is more about managing portfolios for high net worth investors through alternate investment funds and portfolio management services. And yes, over the medium term frame, like maybe in the next year or two, there is an ambition to also commence in India, retail mutual fund operations. So that's the broad mandate. But in reality, if I put it in one sentence, then I think the idea is that there is a pretty large team of investment professionals out here, a 12-member team who manages India equity. And with their competence and investing philosophy, the idea is to serve more and more number of investors across the institutional, retail, and high net worth spectrum.
Great. My best wishes to scale up that, Ashish. I'm sure you'll do well. A great team you already have in place. Let's talk about, you've been, sitting and observing nicely. You've been not talking on media for some time. I'm sure you must have got a lot of time to read a lot. How are you reading the signs right now, the phase of the market we are in from the fundamental side?
No, it is delicately poised. It is delicately poised because clearly, if you see, as far as March and April and the earlier part of this financial year was concerned, there was huge amount of skepticism. But at the same time, if you look at it, the economy going through a kind of complete lockdown because of this natural disaster, maybe the market is seeing it as a one-time impact. That, okay, it's here and now for maybe 3 months or maybe for 6 months. And eventually we will start to normalize. So that's why we saw like a deep cut and then we saw some kind of bounce back. Now, why did I say it's delicately poised? Is because everybody wants to see the rate at which the rate of emergence from the trough or the rate at which the trajectory is actually getting developed. And for the market to keep doing what it is doing, definitely it needs to keep seeing encouraging data. So it's like a very delicate poise of how the market moves versus what kind of data we are actually seeing coming out. And then, of course, on top of that, there are a few uncertainties related to what is happening in the US and the politics and the elections and those kinds of things. But I think as far as we are concerned, it's very difficult to time it. But if I were to stick my neck out, I would say it's the beginning of a new cycle. Because even before COVID came through, we were going through our own set of economic challenges. And I think it's the beginning of a new cycle. Now, at what pace we emerge is what we need to really see.
Fair point, Ashish. You have seen cycles, and there's a new breed of investors which is also emerging from across the country, more tech-savvy mobile phone app users. We were just speaking to Angel Broking MD also earlier, and he was saying the average age of their users has fallen to almost 30 years. But previously we've seen emergence or rush from retail investors to the market as signs of near-term peak or euphoria. Is that fear justified, or is it just coinciding with the rising alarming number of COVID cases globally and lofty valuations in US markets as well? And that's why people are scared.
No, see, I think that clearly there are big trends, and within that there are smaller trends or there are smaller occurrences. So when I say big trend, what I meant to say is, I read it long back that habits change with generations. So from that perspective, clearly, we have a generation of people out here who understand, like I'll just quickly give you an example. If I ask my mother that when I say the word interest rate, what number comes to your mind? I think my mom is going to say more like 10% or 11% or something. And then, if you ask the current generation of youngsters who you are saying is 25 to 30 years of age, you ask them what number comes to your mind when you say the word interest rate. It's more likely that they are going to say something like 4%, 5% or 6% because of this, very well-regarded bank. They splashed the whole country with 4 and 6. So most likely that the youngsters are going to say 4 or 6 or some such number. So clearly today, the appreciation that, to make return, you will need to take risk. I think that's the more generational shift, number one. Number two is obviously within that, the accessibility and the digitization was clearly playing a role. So long story short, I would say that COVID has only kind of speeded up or hastened what was already a long trend. I think COVID has only kind of expedited that whole emergence. That's how I would put it. Yes, within that, one can understand that, a lot of people, some might have got first-time lucky, some might not have had great experiences. But all said and done, I think that it has only accelerated the pace of a cross-section of our population getting engaged with capital market activity. Now, whether they are coming through broking accounts, whether they are coming through SIPs, whether they are doing it, mutual funds, or whichever way you look at it. Right, some advised portfolios, whichever way you look at it. Basically, it is hastening the process of a cross-section of population. Any which way they would have got engaged with capital markets because that was a mega trend. But within that, it got accelerated. That's how I would put it.
Ashish, what did you make of the recent event, the circular from SEBI on multi-cap funds? There was a to and fro from the mutual fund community, and today as well, again, SEBI chief at the Amphi AGM speak about it. We asked him about it because there is clearly the need for the flow of money to widen out in the market. At the same time, these smaller mid caps are deprived of liquidity. They cannot absorb the money. How do you see that space evolve and the regulator's intention versus what the mutual fund community has been practicing so far in terms of multi-cap funds? You are a neutral guy right now. You can tell exactly as you feel.
See, first is that irrespective of how the experience of last 2 years has been or how potentially next couple of years may be, I'll first say that I have always been a big votary of investing in small and mid caps. I mean, because of the volatility and because of the risk, I would still stick my neck out and say from an investor's perspective, somebody who wants to generate wealth or make a good return, from that perspective, it's a necessary evil. Even if you call it evil. I mean, I don't think it's evil, but because of risk and volatility, a lot of people think that it's a space which should be avoided, but I would still say it's a necessary evil. Now so that's my broad perspective that, I think there's no choice but to invest in small and mid caps. Now, how much risk you can tolerate and how much allocation you will put it, it's about individual choices and circumstances. We are no one to dictate it. Now, coming to the regulator's perspective, by engaging with the industry participants in the regulator, what I have understood is that the regulator is very, very keen to ensure that from an investor's perspective, there is standardization and mutual funds are easy to understand. So the regulator went to great lengths to explain to people that, okay, this is a large cap fund. 80% of the money should be in top 100 stocks. Then there is a mid cap fund. At least 65% of the money should be in stock number 101 to 250 by market cap. So on and so forth. Now, within that, there is a multi-cap category. And let's be fair, when you say multi-cap, it does suggest that it will have multiple market cap, money spread across multiple market caps. Now, it's only a quirk of the market, or it's a situation which is here and now. We all know what happened in the last 2 to 3 years with small and mid cap. Economy and oil prices and the ILFS crisis, all those things are not great for small and mid cap to function as an environment, right? So the point is that there is a reason here and now why these mutual funds ended up having a lot of money in large cap. And from a regulator's perspective, then, okay, what's the difference between your large cap fund and your multi-cap fund, which is 85% in large cap, right? So I think that's what has got the regulator to look at it closely, that, if you are going to run your multi-cap fund like a large cap fund today, tomorrow you will run your multi-cap fund like a small cap fund also. So what does an investor really understand out of? So I think that, to put it in words, I think the industry is running multi-cap like a flexi-cap, like across the spectrum. And I think the regulatory intent is that multi-cap is multi-cap. It should have multiple market caps. So I think that's where they are coming from. Some people do believe that we are getting into too much of directing where money should go. Other side of the story is that, the idea is to simplify and, we want people to understand what they are getting into. So I think the industry has to align. That's the way to go forward.
Right. All right, Ashish, we'll let you go on that one. Thanks so much for your time. Good luck on your new innings, and we look forward to seeing more of you on the channel in your new role as well. Thank you very much.
It's my pleasure, Ajay. Thank you very much.
That was Ashish Somaiya, CEO of White Oak Capital, talked to us about the market cycle and where he sees some of the changes and regulatory issues which have been discussed in the industry right now. That's a wrap on the show. Thanks very much for watching. Goodbye.